Hey everyone, welcome back to Corporate Decoder. Today APPL just filed their Q3 earnings report and I am seeing growth in services, but one key metric is lagging behind expectations. Quick note, this is not financial advice, just my take on public filings for educational purposes. While their product sales are solid, the real story might be in how they are balancing hardware and software growth. The period we are looking at is up to the 30th of April 2026. This is a semi-annual report for the Stonebridge Trust, which is a registered investment company. This report covers the Stonebridge High Yield Reinsurance Risk Premium Fund and the Stonebridge Diversified Alternatives Fund. It is like getting a peek under the hood of these investment funds, showing you what they invested in and how they performed over the last 6 months from the 1st of November. 2025 to the 30th of April 2026. Let's talk about costs for a hypothetical $10,000 investment in Class I shares of the High Yield Reinsurance Fund. The costs for these 6 months were about $85. That is 1.67% of a $10,000 investment, but keep in mind, this is annualized. For Class M shares, the cost was a bit higher, around $91 or 1.79%. This tells us that even though these are investment funds, there are expenses involved in running them, and different share classes can have different costs. Now for some key numbers for the High Yield Reinsurance Fund, as of the 30th of April 2026, the fund had massive net assets of over $4.4 billion. It held 373 different investments with a net advisory fee paid of $30.9 million. The portfolio turnover was 10.89%. Meaning they bought and sold about that much of their holdings during the period. This gives you a sense of how active the fund was in managing its investments. Here is where it gets interesting for the High Yield Reinsurance Fund, looking at how they allocated their money based on when their investments are set to mature. A big chunk, 25.2%, matures in 2028 with another 22.3% in 2027. They also had 15% maturing in 2026 and 17.9% in 2029. The remaining 12.2% is marked not applicable, which refers to preference shares and participation notes without maturity dates, and another 0.4% in other, which includes cash and short-term investments. This breakdown shows a clear focus on medium-term maturities with a significant portion set to resolve in the next couple of years. This section of the report helps us understand what the Diversified Alternatives Fund was invested in. The biggest category by far is short-term investments, making up 33.1% of their assets. This suggests a strategy focused on liquidity and capital preservation. Next up are asset-backed securities at 19.6% and event-linked bonds at 31.7%, which are financial instruments tied to insurance risks. They also had smaller allocations to investment companies at 3%, preference shares at 5.4%, and other miscellaneous investments. This diversified approach aims to capture returns from various sources beyond traditional stocks and bonds. For the Stonebridge Diversified Alternatives Fund, the net assets were a substantial $2.18 billion. They held 7,520 different investments with a net advisory fee of $14.4 million. The portfolio turnover rate was 18.17%, indicating a moderately active management style. Now let's dive into the actual holdings of the Stonebridge High Yield Reinsurance Risk Premium Fund. As of the 30th of April 2026, the majority of their portfolio, 87.5%, was in event-linked bonds. These are essentially like bonds that pay out based on whether certain risks, like earthquakes or hurricanes, happen or don't happen. They had a huge variety, with investments spread across Canada, Chile, Europe, France, Global, Great Britain, Israel, Japan, Mexico, New Zealand, and the United States. Looking at the multi-peril category within event-linked bonds for the High Yield Reinsurance Fund, it constitutes a massive 27.6% of the portfolio. This means a significant portion of their risk is tied to multiple types of perils, not just one specific event. Within the event-linked bonds, the United States received the largest allocation at 76.5%. This shows a strong geographical concentration in their US dollar-denominated investments, likely due to the perceived stability and market size. This part of the filing indicates that certain securities are restricted from resale, but the fund's advisor has determined they are still liquid. The aggregate value of these restricted but liquid securities is over $3.8 billion, representing a significant 87.7% of the fund. This highlights the fund's substantial investment in these specialized instruments. Let's shift gears to the Diversified Alternatives Fund and their derivative activity. They had a total return swap with Morgan Stanley Capital Services Inc. The notional value, which is the underlying amount used to calculate payments, was over $312 million. The reported value was $6.4 million. showing a substantial unrealized appreciation. This means the fund is benefiting from this contract at the moment. For the Diversified Alternatives Fund, we see they have sold futures contracts, meaning they are betting on the price of these commodities or indices to go down. Key ones include Coffee C, Copper, Corn, E-mini Nasdaq 100, E-mini Rust 2000, and E-mini S&P 500 index futures. The total notional amount sold is over $133 million, with an unrealized loss of about $2.6 million. This suggests these bets are currently not paying off. On the flip side, they have purchased futures contracts betting on prices to go up. This includes Australian dollar, Brent crude, corn, E-mini Nasdaq 100, E-mini Rust 2000, E-mini S&P 500, gold, KCHRW wheat, lean hogs, natural gas, and sugar futures. The total notional value purchased is over $790 million. Interestingly, these purchased contracts have a lower aggregate unrealized appreciation of about $7.7 million, indicating a mixed performance on their long positions. The Diversified Alternatives Fund also holds purchased options, representing 0.3% of net assets. They've bought put options on the S&P 500 index covering various strike prices, expiring in December 2027. The total notional amount is around $65 million, with a current value of about $1.2 million. This suggests they are hedging against a potential downturn in the market. Diving into the Diversified Alternatives Fund's asset-backed securities, the cost was over $461 million, but by the 30th of April 2026, their fair value was around $427 million. This is a drop of roughly 7.5%, indicating some depreciation in the value of these investments. For the Diversified Alternatives Fund's event-linked bonds, the cost was over $682 million, and they were valued at around $691 million. This shows a slight gain of about 1.3% from their purchase price. Looking at the High Yield Reinsurance Fund's statement of operations for the period ending the 30th of April 2026, investment income was substantial at over $235 million. However, expenses were also significant, with advisory fees alone reaching over $30 million. The High Yield Reinsurance Fund experienced a net realized loss of about $33.9 million on its investments. This, combined with a net change in unrealized depreciation of $19.5 million on investments, shows a challenging period for the fund's holdings. For the High Yield Reinsurance Fund, Class I shares have net assets of over $4.3 billion, with the net asset value per S-share at $8.97. Class M shares, on the other hand, have net assets of about $91 million and a slightly higher net asset value per S-share at $8.99. This indicates that Class I is a much larger and more dominant share class within this fund. Now let's look at the Stone Ridge Diversified Alternatives Fund statement of operations. Their investment income was over $111 million. However, their expenses, particularly advisory fees at $14.4 million, and a massive $278 million unrealized loss on futures contracts, significantly impacted their bottom line. In a stark contrast to the high yield fund, the Diversified Alternatives Funds, net realized gain or loss on investments from unaffiliated issuers was a loss of over $24 million. This negative result is further compounded by a substantial unrealized depreciation on futures contracts totaling over $278 million. For the Stone Ridge Diversified Alternatives Fund, Class I shares had net assets of over $2.1 billion with a net asset value per S-share of $10.25. Class J shares, which used to be Class M, had net assets of about $55 million and a net asset value per share of $10.19. The Class I shares significantly outweigh Class J in terms of assets. Looking at the Diversified Alternatives Fund's asset-backed securities, the cost was over $461 million, but the value dropped to about $427 million. This implies a loss of roughly 7.5% on these holdings. Within the same fund's event-linked bonds, the cost was over $682 million, while the value increased to approximately $691 million. This indicates a gain of about 1.3% on these securities. The total asset-backed securities portfolio for the Diversified Alternatives Fund has a cost of over $461 million, but is currently valued at about $427 million. This reflects a loss of over $33 million. The event-linked bonds for the Diversified Alternatives Fund show a more positive picture, with a cost of over $682 million and a fair value of about $691 million. The fund has also purchased options, primarily put options on the S&P 500 index. The notional value is considerable at over $65 million, but the current value is only about $1.2 million. This protective strategy against market drops has likely cost money, which is typical for options. For the Diversified Alternatives Fund, the portfolio allocation shows a heavy reliance on short-term investments at 33.1%. This is a common strategy for funds aiming for stability, but it also suggests a cautious outlook or a parking spot for capital. The total net expenses for the high-yield Reinsurance Fund were about $34.4 million. For the Diversified Alternatives Fund, the expenses were much lower at just over $18 million. This difference is mainly due to the much larger asset base of the high-yield fund, resulting in higher advisory fees. Both funds saw significant capital share transactions. The high-yield fund had a net increase of over $579 million from sales and redemptions, while the Diversified Alternatives Fund had a net increase of over $307 million. This shows strong investor interest in both funds. Now for the story and the numbers, the high-yield Reinsurance Fund experienced a significant drop in net assets from operations, mainly due to realized losses and a substantial unrealized depreciation on investments, totaling over $33 million in losses. The Diversified Alternatives Fund, however, saw a net increase in net assets from operations, helped by a large realized gain on written options, which more than offset their losses in futures contracts and investments. Looking at the total return, Class I shares of the high-yield Reinsurance Fund had a return of 4.58% for the period, while Class M shares had a slightly lower return of 4.42%, likely due to their higher expense ratio. For the Diversified Alternatives Fund, Class I shares delivered a return of 4.93%. And Class J shares had a return of 4.80%. The numbers show both funds performed reasonably well in what is likely a challenging market. Overall, these filings give us a snapshot of these funds' activities. The high-yield Reinsurance Fund appears to be weathering some losses on investments, but still manages substantial net assets. The Diversified Alternatives Fund showcases a broader strategy, utilizing various instruments like derivatives and loans, with a heavy emphasis on short-term investments for liquidity. The difference in expense ratios between share classes also remains a key factor for investors to consider. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.